thank you to Savvy Ladies for continuing to spread financial literacy to the public, and I'm happy to be a part of this webinar series, my second presentation thus far with Savvy Ladies. So very excited to be with everyone today. Thank you for taking the time out of your busy schedules to learn about today's topic, which is titled Protecting Your Income. And we're going to go through a list of different ways we as individuals, as working individuals, can protect our income, and just be aware of some of the risks that are out there and how we can protect those risks. So basically we'll start with really the first slide here. Excuse me for 1 second. So just our usual MassMutual disclaimers. The company I work with is MassMutual. So here on page 4, or slide 4, we want to really define what is financial well-being, and maybe other individuals have different answers to what financial well-being might be. But there was a survey done by the Consumer Financial Protection Bureau back in 2015, and there were really 4 main areas of what people consider to be well-off or well-being financially. And so having control over your day-to-day or month-to-month finances, having the ability to manage risk or absorb certain shocks that are unexpected, being on track to meet certain financial goals, whether it be buying a home, sending your children to college, retirement, or anything else, and then also having really the ability or flexibility to make choices in life. And I think that's really something I tend to spend a lot of time on, is really making sure that we have choices and flexibility, and I think that's key to financial planning. I did forget to mention that I very much like to keep this as an open dialogue. Generally speaking, when I'm presenting in person, I'll take questions throughout the presentation. What I would ask everyone to do on today's presentation via conference call, via WebEx, is to hold all your questions towards the end of the presentation. So it is encouraged that if you do have a question as we go through the topics and the slides, to write down your question. I'm going to leave plenty of time to make sure that everyone's questions are answered. All right, so moving forward, let's define, what protecting your income looks like. And I'll kind of skip ahead a bit, but I'll say this. When I'm often presenting this topic, I'll toss the question out to the audience and ask them, what do you think your most valuable asset is? And we'll typically get answers such as my home, or my retirement plan, my 401k, maybe my car, things of that nature. And while all those assets are valuable and can certainly be a large sum of money or worth a good sum of money, it's not really your most valuable asset. Our most valuable asset as individuals is our ability to earn an income. If we can't wake up in the morning, get to work, earn a living, everything else falls apart. And so I would submit to the audience today that the most valuable asset that you have is your income, your ability to go up, wake up in the morning, and produce an income. So we're going to look at sort of 5 areas today: the value of your income, the risks that can come into play regarding your income, defining the disability, how to replace your income, and then talking about the different types of disability income insurance that is available in the marketplace and potentially at your employer. I really like this slide because obviously when you think about your income, you're thinking about paying the day bills, but I'm always reminding the folks that I work with that money is important, but it's just a tool, and it's a tool to help you get what you want out of life, and what you want within your family, your community, what you want out of your career, what do you want for yourself, right? So whether it be saving for a home, whatever it might be, I really encourage the clients and the individuals I work with to really understand what your goals are. When you start the financial planning process, really understand where you're going, what's important to you, what do you want to see have happen, and then work from there. And I think that really brings more meaning to what you're trying to accomplish. So I really like this slide a lot because it just really talks to, yes, your income is valuable monetarily speaking, but there are intangible parts to yourself, whether it's self-development or the things that you enjoy or the people you spend time with or the individuals or institutions or organizations you give back to, or just your career in general from a perspective of bettering yourself or advancing in your career. So the value of your income goes way above just monetary dollars, and I really like that slide there. In insurance world, how do you define the value of your income? And we call this human earnings value. And it's a very simple calculation, right? How many years do you have remaining, right? So if I'm 35 and I'm going to work till 65, I have 30 years to go, and my salary is $100,000 a year, let's say. I have the capacity to earn $3 million over my lifetime. And in the example here, we use an individual who's 30 years old. He or she intends to work another 37 years and make $75,000 a year. So if you multiply the fact that this individual has 37 years to go at $75,000, his or her potential or income potential is worth about $2.7 million. And I'll pause here for a second because we often don't think about it in those terms, right? First of all, this doesn't even include inflation, the fact that generally speaking our income will increase over time. So $2.7 million is what you have the capacity to earn over 35 plus years, whereas the average home in America, the average car, or an average piece of jewelry, as you see here on the slides, are fairly or much more significantly less than the value of your income. So again, that question I posed to the audience of what is your most valuable asset, most people say your house, which is certainly a very respectable answer, but if you put it in terms of your earnings potential, that's something that we really need to think about. So, I often use a very simple analogy. If you had a machine in your basement that was printing out $100 bills every morning, chances are you would make sure you'd buy insurance to protect that machine. Well, at the end of the day, we are that machine. We're the individuals going out there, earning that living, making that paycheck, bringing home dollars to support our families and ourselves. It makes sense to protect that. So we're going to talk about how to do that in today's presentation. I'm going to shift into different types of risks that are out there. Aside from disability, right, I like to look at the other, what we call involuntary risks, things you really cannot control to your income, right? And the three main involuntary risks are death, disability, and unemployment. So we'll take a look at each. First is death, premature death. This is really where life insurance can come into play. So I kind of talk about, when I talk about financial planning, it's the same as building a home. When you start with building a home, you start with a foundation, right? When you build a home, you start with a solid foundation to build upon. The same holds true when it comes to financial planning. It's important to make sure that we have a solid foundation. And to me, as a planner, building a solid foundation really ensures that you're protecting the risks that are involuntary to your income. So death and disability are, to me, insurance pieces that you want to make sure you're protecting if it makes sense. So for example, why do people buy life insurance? Well, to protect an income that may be lost, right? So if someone depends on your income, whether it be a child or maybe an aging parent or a distant relative, if God forbid something would happen to you and you're no longer here, that income stops, and that individual who depends on your income may no longer have a financial resource to count on. So this is something that I encourage the audience to think about. If you have children especially, or individuals who depend on your income, life insurance can be a very unique tool to replace the income that is lost. So the example they give here is if you had a $500,000 policy, that can generate about $75,000 of income for 7 years. And so when I speak to young families who have maybe a newborn and they're making 75 grand a year, and I tell them they should have $1 million of insurance, they think that's a large number, but at the end of the day, $1 million, would generate maybe 12 to 18 years, depending on the return, of replaced income. So those are some things to consider when protecting your income in the event of a premature passing. On the other hand, you have unemployment, right? Most, if not all of us, if we're working for a major firm or even a small firm, have unemployment insurance. So if something were to happen, you're unemployed for a period of time, obviously your income also stops. Unlike death where you're no longer in the picture, here you're still around. So not only do you have the expenses of your family or your loved ones who depend on your income, but you also your own personal expenses. So I think that's something to really consider. What we as planners generally recommend, because again, this is something that's involuntary, there's no such thing as buying yourself an unemployment policy, is really to make sure you have an adequate emergency fund. If something were to happen, at least you have a certain amount of dollars that is liquid cash available to get to in a savings or a checking account to help bridge the gap between, the separation of employment until you find new employment. You'll see ranges of months between 3 months to 12 months on hand. I personally will say if you're a single wage earner in a family of 2 or more, you probably should have 6 to 12 months on hand. If there are 2 wage earners in the household, you might be able to get away with 3 months because there's another spouse or partner earning income. But you generally want to have anywhere between 3 to 12 months of expenses on hand. I always encourage our clients to complete an expense worksheet, which I'm happy to send over. If I receive a list of emails, I'll send out an expense worksheet. I think this is probably one of the best places to start, so just to raise awareness as to, okay, here are my monthly expenses. If I were to A, pass away, how much does my family need? B, become unemployed, how much do I need an emergency fund? And then C, if I'm disabled, how much disability insurance do I need? So the expense worksheet is, I think, a key component to understanding how to cover your risks and for how much. So, even if it may take a year, for some folks I work with, it may take a year to develop that emergency fund. I can't tell you how many folks would say, yeah, I want to start investing, but they have nothing in the bank. An emergency fund is pure cash in a checking or a savings account. It's not invested. It's pure liquid. You can get to it same day. Doesn't come with fees or anything of that nature. And that's really the best place for an emergency fund, where it's not in the market and subject to any risk. And then shifting to the last risk, which we're going to cover more in detail today, is the risk of becoming disabled. And the statistic they use here is the average 20-year-old, the risk of becoming disabled before age 67 is 1 in 4. And I think the risk for someone in their 30s is about 1 in 6. So the simple analogy I use there is the elevator bank here in my office has 6 elevators. And if I told you that if you get in one of these elevators, right, of the 6, one of them is going to plummet all the way down and to the first floor, chances are you're not going to walk into any of the elevators. Same holds true with disability, right? If you have a 1 in 6 chance of becoming disabled, why are we taking risks in not covering that every day we go out there? So we're going to talk about that a little bit more detail. So these are some interesting statistics, as you see in the slide. 1 in 4 for a 20-year-old not being able to work. Odds of being involved in a car crash, 1 in 5. Identity theft, 1 in 14. And odds of an IRS audit, 1 in 119. So pretty interesting statistics, especially as we hear more and more about identity theft. We really don't hear much about disability or not being able to work. Shifting ahead, so let's make sure I didn't skip a slide there. This was a very eye-opening slide for me as well. When I presented this a couple years back, most individuals think disability is the proverbial getting hit by the bus, right? Or you're crossing the street and a car hits you, God forbid. In fact, 90% of disability claims or causes are due to an illness, not necessarily a car accident or getting hit by a certain, the proverbial bus. So I think that's definitely important to keep in mind. And then this is kind of the breakdown back in 2013 of the leading causes of disability, most of them being musculoskeletal or connective tissue, whether it be bad back or arthritis, things of that nature. So I'll leave that up there for a second, but I thought that was pretty interesting compared to, hey, me actually getting hurt. What happens if you were to become disabled or unable to work, sick or injured and unable to return to work? Obviously, as discussed before, you're losing your ability to earn an income, but there are what we call unintended consequences, if you will. Perhaps the separation of services, right? If you're out of work for more than 6 months, your company doesn't necessarily have to hire you back. What else are you losing? Possibly health insurance, which can be a huge factor for a lot of folks who are getting subsidized health insurance through their employer. Getting on the exchange or picking up COBRA health insurance can be very expensive. The other thing that we also think about is, when you stop working, obviously, or unable to work, you're not bringing any income in, but you're also not saving, right? So you're not putting money away for the long term. You're not putting money away for retirement or the college fund that was important to you, or that second home. So that's something we really need to keep an eye on, right? Not only are you depleting your resources, but you're not saving. So I get back to that analogy, or not analogy, but that building a house, building a foundation. Again, you're going to start saving for retirement, but if you're not protecting your ability to save, it can all be wiped out in one fell swoop. And then there's other things like increased medical costs, and you're dipping into your savings. So again, it's more than just losing your income. There are other things to consider. So in the unlikely or unfortunate event, rather, that something should happen to one of us, what is around? Well, number one, you have Social Security disability insurance. You have workers' compensation. You have what your employer may or may not provide you, and then you can purchase disability insurance in the private marketplace. So we're going to go through all four of them. First, Social Security may have limitations. First and foremost, for those of you who may know someone who applied for Social Security disability, generally speaking, it doesn't happen right away. Oftentimes, they actually will deny the first claim or even second claim, and oftentimes you have to have a good attorney helping you apply for that. Second, you have to make sure you're covered under Social Security disability, so you have to have a certain number of years in the Social Security system on the books in order to retain Social Security, Social Security disability. But is it enough? I think my Social Security disability would be about $2,400 a month if, God forbid, something should happen to me. Is that enough? Certainly not. That would maybe just cover the mortgage, and that's about it. So, $2,400 a month in New York doesn't really go far. So again, Social Security disability, while it may be there to a certain degree, may not be enough for what you need. If you wanted to check your disability amount through Social Security, you can actually go to www.ssa.gov. That's ssa.gov. We no longer receive Social Security benefits in the mail, but if you go on that website, you sign on to My Benefits, you can actually get a copy or printout of your disability benefits along with your retirement benefits, so at least you can get an understanding of what is there. So hopefully that's helpful. Workers' compensation, also a lot of limitations. In order for you to claim a workers' compensation disability, you have to have gotten injured on the job. And according to these statistics, less than 5% of accidents or illnesses are work-related. So again, the odds are not in your favor if you're just relying on that. And then your employer group long-term disability may also have some limitations. So what I would encourage everyone to do after we get off the call today is really go back and understand what your group offers. The next slide really talks about what you should look at. So this is typical. You get 60% of your salary, but sometimes there are caps. So hypothetically, you're making $1 million and they say, well, we're going to cover 60% of your salary. Well, that would be great. I'm getting 600 grand a year. But they may only cover up to 10 grand a month, right? Or 5 grand a month. So one thing to look at is, are there any caps? If you were to become disabled at work, does your disability insurance have any caps or benefit caps? Benefits may be taxable. So this is easy to discern. If the company is providing the long-term disability to you for free, and then in the event you become disabled, that benefit is taxable. So we're going to go through that in a slide. So if you have a $5,000 a month benefit and they're paying the premiums for you, when you go on claim, that's $5,000 of taxable income to you. Whereas if you are paying the premiums, then the benefit would be tax-free, meaning I get injured, I have a $5,000 a month benefit, but because I was paying the premiums, that 5 grand is completely tax-free. Again, that is very important to understand, and you can find that out in your benefits manual at work, as well as just looking at your pay stub to see if there's a deduction coming out for something called LTD or GLTD. And the other thing, too, is I work with a lot of folks on Wall Street, and a lot of their income is tied to bonuses or some type of award or merit based income. So again, they may cover your salary, which is 100 grand, let's say, but it doesn't cover your bonus of, let's say, 200 grand. So again, the language in your group long-term disability is a key component to understand. So again, in this scenario here, right, they're just looking at, well, here's your salary, 75 grand, but you also get a 10 grand bonus, so you're getting 85 grand a year. Well, they're going to cover 60% of your salary, but that is taxable. So 60% of your salary only minus taxes leaves you with $33,000. So that's almost half of your income, right? So again, understanding the key differences is so important between taxes, who's paying for it, and what the caps are. So again, this slide here just says which of these things would you have to get rid of, right? And again, getting back to the fact that there are unintended consequences, not just about the monetary loss, but all the other things around you that are important, your family, your community, and so forth. Okay. So part of what I do as a planner is help individuals understand whether or not there is a gap, and if there is, help them figure out whether or not they should apply for individual coverage. And that's really where you have to figure out, number one, what are your needs, understanding your expenses, 2, understanding what you have in place, and then 3, if there's a gap, how do you bridge that gap? I'm always a big proponent to have both group coverage and individual coverage, because let's say you decide to leave your employer, well, your coverage stops. So I'm always a big proponent of having some type of personal coverage, albeit maybe a little bit more expensive. Coverage that you have is seamless, right? To that last point there, it's fully portable. So if you leave your employer today, all of your benefits, including disability, life insurance, stop. A personal policy continues with you. And generally speaking, the benefits are tax-free. So in this scenario, they're just showing the individual who purchased more disability insurance, helps kind of get closer to that bridging that gap there. Kind of a busy slide, but again, I think the really bottom line here is just understanding if there is a gap, and then if so, how do you replace that gap? So I guess in summary, there's kind of the last slide here, remembering that, again, your income is your most valuable asset. and don't ever forget that. I think it's so important to understand that we as individuals spend a lot of time, whether it be learning a trade or in school or just bettering ourselves, to put ourselves in a position to, increase our income. What are we doing to protect that? And, there are unintended consequences that we don't think about, especially the fact that we're not saving anymore, and the fact that, your other goals can be compromised, right? So if you want to send your child to college or you want to retire, well, if you can't work anymore, again, those goals could be compromised because of the lack of income. So, again, I will send out, if I have an email for everyone, or I'll send it out to Maggie, and then she can disperse it from there. I think the expense worksheet will be a very key starting point. I'm big on call to action, right? To me, there are three types of people, right? People who don't believe your message, people who believe your message, and then the third type is people who believe your message and take action. Hopefully today we have people on the phone, on the call, who are going to take action. So complete the expense worksheet would be the first step. The second step would be really to understand what you have at work, and then if there's a gap, reach out to a professional who might be able to help you. So I felt like I went quickly, maybe because I wasn't able to take any questions, but I do want to open the line for any questions that are out there. I have plenty of time to do that. So Maggie, if you don't mind, if you want to open up the line to see if anyone has questions, I'd be happy to answer them.
Great. Thanks, Matt. I'll remind everyone, if you have a question, you can use the chat box here, or you can email info@savvyladies.org. So the first question we have for you is, are there various levels of coverage among individual disability income insurance plans?
Yes, the question was, are there various levels of coverage? The answer is yes. So really it depends on your income. So for example, let's say you're making $100,000 a year, just to use round numbers. Underwriters look at disability insurance from two aspects. There's a financial underwriting, and then there's a medical underwriting or a risk underwriting. So I'll start with the financial end of it. You can't really take out more than 66 2/3 of disability insurance on your income. So for example, I can't go out there if I'm making $100,000 and buy a $10,000 a month policy. I would actually be putting myself in a better position by becoming disabled financially, obviously not, living wise, because I'd be making $120,000 a year if I were to become disabled. So typically New York State and other states cap it at about 66 2/3. So when you're out there and applying for individual coverage, if you are looking to get individual coverage, the company will want to know what you have available at the group, so that you're not overinsured. Because if you are overinsured, the benefits can be reduced. You can't put yourself in a better position. So typically, policies are sold in $500 increments, $500 a month, $1,000 a month, $5,000 a month, so on and so forth. And then the other part of the underwriting is the risk part of it, right? So obviously being able to, if you're in good health, that helps. But also, my wife is a nurse. So she's in a higher risk category than, let's say, an attorney, right? Statistically speaking, nurses are more prone to becoming disabled due to the physical nature or stress, whatever it might be. Versus an attorney who's not really doing much physical work. So an attorney will pay us a cheaper premium compared to that of a nurse. Firefighters, police officers, some occupations cannot even apply for coverage because of how dangerous their line of work might be. So those are the two components, right? Your income, the financial aspect of it, and then the risk part of it in terms of the what you do for work.
Okay, thanks, Matt.
No problem.
Another question is, what are the DI options for the self-employed? Can we access state disability insurance?
So great question. So self-employed individuals certainly have the ability to go out in the private marketplace and get individual disability insurance coverage. It really depends then. So the answer to that is yes, you can get individual private disability coverage. So I have some consultants and individuals who are on a 1099 basis, real estate professionals who purchase disability insurance through me. In terms of the state-mandated insurance, if you run a business and have employees, you're going to be mandated to have workers' compensation, but you're not mandated to have long-term disability. If you're a 1099 solo practitioner, you don't have to have the workers' comp, but if you have other employees and you're running a business, generally speaking, workers' comp is a requirement. That helps a little bit.
Okay, thanks. Another question for you is, if I become disabled and don't have disability insurance, is it something that I can purchase after an accident or illness?
Good question. The answer is no, right? So, if you become disabled, remember, you're shifting insurance is just a matter of shifting risk. So if I'm an individual, it's a decision to me. Do I want to take on that risk myself, or do I want to shift that risk to the insurance company? So the insurance company is not going to say, well, you're disabled now, pay us a premium and we'll pay you a monthly, $5,000 a month tax-free. So the answer is no. You have to have had it in place before the disability or illness occurred. Trying to think of what else to expound. So yeah, I mean, I think I read a quote somewhere about similar to life insurance. Best to have life insurance, 5 years too early than a minute too late. Right, so certainly examine whether or not you need disability insurance, and it's something that you can't get once you're disabled.
Okay. This next question is, how can you make a decision which insurance company to choose? Do you have some guidance on that?
Absolutely, that is a great question. So I think it comes down to number one, going with an insurance company that's around for a while, that has good ratings. So there are some ratings agencies out there, Moody's, S&P, Fitch, AM Best, who rate the insurance carriers, and you're basically looking for an A rating or better. Companies that come to mind: Principal, Mass Mutual, Guardian, Northwestern, The Standard, Lloyd's. These are all companies that are actively writing disability insurance policies that have been around for a while and are very competitive in the individual marketplace. So, I typically would ask, I shop around for my clients depending on their situation. Sometimes, let's say Mass Mutual, the company I work for, is better suited for physicians and white-collar workers, and Principal, I find, is often better, or The Standard is often better for blue-collar workers. So it really depends on what you're doing and the level of income replacement you need. So basically, bottom line is just go with an insurance company that's reputable and has an A rating or better, and because that's the other side of it. You pay for insurance, you want to be able to make sure that it's going to pay out, right? So if you're on claim, you don't want to have to worry about the insurance company fighting you to say you're not on claim, right? They typically will send a third party out to make sure that the doctor says you're disabled, unable to work, and things of that nature. So the claims process, I don't want to say it's not easy, but you have to prove that you're not disabled, and generally your physician will do that for you. So it's not. I certainly have clients who have unfortunately had to use their disability insurance, and it's just an administrative process that you go through.
Okay, and this next question is asking if should everyone buy private disability insurance, or can some people do without it?
Yeah, it really depends. So like last couple of plans I worked on, it really runs the gamut. I had a handful of clients who had enough at work, and because their expenses were so low, what they had at work was fine. And on the other hand, we found that there was not enough cash on hand, or they didn't have enough savings or emergency fund, and some of the goals were lofty that without it, it could compromise their goals or their well-being. So I'm an advocate for it. I think everyone should have some sort of disability insurance. So if you have nothing at work, I would say certainly you should have some. If you have something at work, then it's just a matter of understanding if there's a gap.
Okay. I think we have a few more questions for you. This next one is, my employer does not provide group long-term disability insurance. Does that mean that I would need to get individual disability income insurance to cover 60% of my salary?
Well, I mean, if your employer doesn't offer any coverage, then the answer is yes, you would potentially need coverage to protect your income. Is 60% of your salary what you need? Well, that's where, again, the expense worksheet comes into play. You might fill out your expense worksheet and see that you're spending $5,000 a month, just for hypothetical purposes. Of that $5,000 a month, maybe $1,000 a month is going towards play, right? Vacations, entertainment, things of that nature. You might say to yourself, listen, if I become disabled, I'm not really going to do much of that anymore, so I don't need $5,000 a month, I need $4,000 a month. So what I try to help encourage individuals to think about is, what are your absolute needs to continue your lifestyle, not only now, but throughout retirement, if that disability should last. So to answer the question very simply, yes, I would encourage that individual to look in the private marketplace for coverage. Is 60% the right amount? Again, comes down to what your income needs are.
Okay, thanks. Another question is, do you recommend having an emergency fund before purchasing disability insurance?
I think they kind of go hand in hand, but at the end of the day, it's not something that they're kind of mutually exclusive. I think you build up your emergency fund, but at the same time, you start purchasing the disability insurance, because the worst thing that can happen is, God forbid, you become disabled or sick or injured while you're building up your emergency fund. Typically speaking, a long-term disability policy will kick in month 3 or month 6 on average. So most of the policies they sell kick in month 3. So typically that means I want to make sure from months 0 to 3 I have enough cash on hand to bridge that gap. So it's kind of a way to look at it. So I think it's kind of a concurrent thing that you would look to do.
Okay. All right, I think this is our last question for you. It's asking if you have a ballpark figure of how much individual disability insurance costs, or if you could give a best estimate for it.
Yeah, so that's kind of all over the place, because it really depends on what you do for work. So remember, there's a couple of factors play into the pricing: your age and your sex, as well as what you do for a living. Disability is a little bit more expensive for females, whereas life insurance is a little less expensive for females. Why? Because actuarially speaking, females live longer than males, so there's a larger likelihood that it's going to cost the female more to replace income. So disability insurance is a little bit more expensive for females. My wife is certainly not happy paying her disability premium because she's a nurse, as I said before. So her premiums are pretty high. They're about $100 a month for, I think it's a $2,500 a month policy. Whereas if she were an attorney, that premium might be closer to $40 to $50 per month, or maybe $60 per month. So it really depends on your age, right? If you're 55 years old, it's going to be more expensive than if you were 25 years old. So the younger you are, typically speaking, the less expensive it is.
Okay. Matt, do you have time for one last question that just came in?
I certainly do. Absolutely.
Okay. Is the cost of these insurance tax deductible if you itemize?
No, it is not. It's an after-tax cost. Now, as a business owner, if you're a business owner or a 1099, you can certainly deduct them if you're itemizing on a Schedule C. But keep in mind, if you're going to deduct the premiums, if you were to become disabled, your benefit now becomes taxable. So myself, I'm on 1099. I have three different policies. I don't deduct any of my policies. Why? Because if God forbid something should happen to me, I want that tax-free benefit. So I often, and in the business owners I work with, I often encourage them not to deduct it because I want them to have the tax-free income versus the taxable income.
Okay, great, thanks. All right, so those are the questions we had. So I want to thank you, Matt, for a really, really great presentation, and thank you so much for taking the time to answer all of our questions and explain everything. I want to thank everyone for joining us today. We hope that you'll be joining us again. Thanks so much, Matt.
Thank you, Maggie. Thanks for having us. Appreciate it.
Thank you.
All right,
Bye-bye.
take care. Bye-bye.